A bank can look healthy and still collapse in 48 hours. That isn't a paradox, it's the core design of modern banking. A bank can report solid profits, a strong capital ratio, even a safe portfolio of government bonds, and yet die fast if enough depositors demand their money at the same time. A bank run isn't primarily a story about bad loans. It's a story about time. What can be sold today versus what is promised today. First, here's what a bank is really promising you. When you put money in a bank, the promise feels simple. You can withdraw on demand, in full, with minimal friction. Your balance looks like cash, and the payment system treats it like cash. But a bank is not a vault. It is a machine that converts short-term deposits into longer-term assets, mortgages, business loans, municipal debt, and securities. In exchange, depositors get convenience, payments, and sometimes interest. The economy gets credit, investment, and growth. So the bank is effectively making two promises at once. To you, it promises liquidity. Your money is available when you want it. To borrowers and markets, it promises commitment. We will hold and manage long-dated assets over time. The glue that makes this work is confidence. Most days, only a small slice of depositors withdraw, so the bank meets requests with cash on hand, incoming loan payments, and small, routine asset sales. The system runs on the assumption that withdrawals are staggered, not synchronized, like a stampede. Now comes the mismatch that makes runs possible. Here's the simple mismatch that can break a nation. Deposits behave like a light switch, while bank assets behave like a slow-moving machine. Deposits can leave instantly, one tap in an app, one corporate treasury decision, one viral post. But the assets backing those deposits are often long-term and illiquid. A 30-year mortgage can't be collected tomorrow. A bond that matures in 5 or 10 years can be sold tomorrow, but not at the price you paid, especially if interest rates have risen. This is where looking healthy can be misleading. On paper, a bank may hold high-quality assets, government bonds, prime mortgages, investment-grade credit. The problem is timing and pricing. If rates rise, the market value of existing bonds falls. Those losses may be unrealized as long as the bank can wait to maturity, but a run forces the bank to sell now, locking in losses. Sell enough, and capital erodes. Capital erodes, and confidence collapses. Confidence collapses, and more deposits flee. Two accelerants make it worse. First, concentration. If a bank's deposits are dominated by a few large businesses, often with balances above insurance limits, those depositors are more likely to move quickly and in huge size. Second, duration risk. If the bank reached for yield by buying longer-dated assets, its market losses in a rate jump are larger, and its weighted-out strategy becomes fragile. Notice the feedback loop. Withdrawals force sales, sales create losses, losses weaken the bank, weakness triggers more withdrawals. It's not that the assets are bad, it's that the balance sheet is vulnerable to speed. In a modern system, speed is everything. When withdrawals happen over months, the bank can manage. When they happen over hours, even a conservative portfolio can become a death trap. And here's how panic actually starts. A bank run usually begins with a story, not a spreadsheet. It can be a rumor about losses, a headline about a failed capital raise, a sudden downgrade, or a single large depositor pulling out and signaling, "I'm leaving." In the old world, a run moved at the speed of lines outside branches. In the new world, it moves at the speed of group chats and payment rails. Once fear enters, depositors stop asking, "Is my bank solvent in the long run?" and start asking, "Will I be early or late?" That shift is fatal, because it turns rational caution into a race. If you believe others might withdraw, the safest move is to withdraw first, even if you think the bank is fundamentally okay. The run becomes self-fulfilling. The act of protecting yourself is what creates the danger. Psychology matters, but mechanics finish the job. Liquidity buffers are limited. If withdrawals exceed cash and easy-to-sell securities, the bank must sell harder assets at discounts, or borrow against them. Discounts create visible losses. Borrowing can look like desperation. Every new action meant to survive becomes fresh evidence for the crowd that survival is uncertain. And in a crisis, uncertainty is enough. So what stops it? That's where the backstops come in. Modern states built backstops because uncontrolled bank runs don't just kill banks, they freeze payrolls, break supply chains, and turn a financial problem into a political one. The first backstop is deposit insurance. In the United States, the FDIC guarantees deposits up to a legal limit, which is designed to remove the incentive for ordinary households and small businesses to run. If you believe your insured money is safe, you don't need to stampede. But insurance is not the whole story. Large depositors may be uninsured, and fear can still spread. That's where the central bank enters. The Federal Reserve acts as lender of last resort, lending short-term cash to solvent banks facing temporary liquidity stress. Mechanically, this can happen through the discount window or through emergency facilities, allowing banks to borrow against good collateral rather than fire-selling assets into a panic. The key distinction is liquidity versus solvency. Liquidity is a timing problem. You have assets, but not cash, right now. Solvency is a value problem. Your assets are not worth enough to cover your liabilities. Backstops can fix liquidity by buying time. They cannot magically fix insolvency without losses landing somewhere, shareholders, bondholders, a merger partner, or, in extreme cases, the public. And that's why backstops are always a trade-off. They reduce panic and protect the payment system, but they can also create moral hazard, the temptation to take more risk if rescue is expected. The art of crisis management is to stop the run without rewarding reckless behavior. Here's the takeaway, what to remember the next time. Bank runs are not relics of black and white history. They are a permanent feature of fractional reserve banking because the system is built on confidence and timing. The lesson for depositors is simple. Understand your exposure, know what is insured, diversify large balances, and watch concentration risk if you keep big operating cash at one institution. The lesson for banks is tougher. Liquidity is not just a ratio. It's a story you must survive in real time. If your funding base can flee in a day, your assets must be liquid enough to meet that day, or your borrowing lines must be unquestionably credible. Duration risk, uninsured deposits, and weak communication are a combustible mix. And the lesson for nations is the hardest. A bank run is a speed test for state capacity. When trust collapses, the response window is measured in hours. Get it wrong, and a banking shock becomes a national crisis. A bank can look healthy and still collapse in 48 hours because in banking, confidence is the one asset you can lose the fastest.